Hello, I'm Van Hansen, and welcome to Housing Horizon, your market economics and mortgage matters. I'm here with Joe DiGiambattista from Go Mortgage Co., the principal broker. And good morning, Joe.
Good morning. How are you today, Van?
I'm very well. And yourself?
Very good. No complaints.
Okay, Joe, so you've got some key dates for us to start off.
Absolutely. And, it's important that we keep an eye on what is being measured in the economy. That's going to help us understand what potentially could be happening to rates as well as the housing market. We've broken those dates down to inflation and BOC for both Canada and the U.S. In Canada, the next reading is going to be out on the 19th, but we got a little bit of some information probably Thursday or Friday suggesting that we expect our CPI to go from 2.4 to 3.1, which is a 0.7 increase, which is material. We were at 1.8 and we went to 2.4, and now we're at 2.4 and we're going to 3.1. So we're getting a sense there's upward pressure on inflation. The next rate announcement is going to be on June 10th. As of today, when we look back, there has been no change since October. I think we've had 4 cycles where we did not increase rates or decrease rates. But the expectation is that on June 10th, if we see, the same type of inflation at 3.1, we're having a little bit of a softer time in the marketplace from unemployment and a GDP standpoint. So I don't suspect any upward pressure on rates. Yes, there's upward pressure on inflation, but I don't think it's enough yet to spur a rate change, neither up or down. So we'll definitely keep an eye on that. US is a little different. They jumped from 3.3 to 3.8, and they were like 2.4 to 3.3 last month. So they're experiencing a little bit more inflationary pressure than we are. For them, it's a combination more of the energy crisis and tariffs. So we're seeing that impact down there. There's upward pressure on their rates for sure, but they're a big proponent of trying not to increase rates. They actually want to reduce rates, which would be counterintuitive. So we'll definitely keep an eye and see what's going on with them. Their dates are June 10th and June 7th.
Okay, great. And maybe we can take a little bit of a deeper dive into the headline and the core inflation. Maybe you can break that down a little bit.
Absolutely. This is a look at where it is in March. So we're adjusting for what we think April is going to be based on what we've read, but we don't have the actual March breakdowns yet. The April breakdowns yet. That's going to come out after May 19th. But these are for March. You can see where the impact is. It's really energy is really the big one. So we expect headline inflation to go to 3.1. We expect energy to be the major cause of that, with year-over-year impact of 3.9, month-over-month impact of 13.1. So that's where we're getting the upward pressure from, Van. The good news and what I'm tickled pink about is core inflation hasn't moved. So if we take out, headline inflation includes gas and food. If we strip out gas and food, inflation's not going up, right? That's good news. That means we're not seeing the impact from tariffs, and that means the economy is working within a balance. So I think that the fact that we're not seeing core inflation move up is very positive.
Okay, great. And as far as the rate forecast goes, this is not uncommon, but we're seeing on the chart a little bit of a divergence between the fixed and variable rates. So what can you say about that?
Yeah, very astute. When you look at 2022 or 2023 to 2025, you notice the variable rate is higher than the fixed rate. But then you go from 2015 to 2022, and pretty much the fixed rate was higher than the variable rate. That's normal. It's normal for the fixed rate to be higher than the variable rate. It's not normal for the way it's been the last 3 years. And we're starting to see that invert. And you can start, if you look at the end there of 2026, it's starting to create a bit of a gap. And we're starting to see that gap spread, which is good news because, there's no incentive to take a variable rate when it's higher than the fixed rate. The whole value of the variable is the opportunity for rates to potentially come down or stay at a lower number than the fixed. And that's traditionally where it is today. So we're seeing the fixed around 3.6 sorry, the variable around 3.6 and the fixed in the low fours. So that spread of 50, 60 basis points is making people think. Is it better for me to take the variable now, ride the low part, save the 60 basis points? If the market starts to move, flip into the fixed rate, because you can do that with the variable with no penalty, so it's a great feature. Or continue to write it down. If you look at a 20-year rollback, you're usually saving money if you're taking the variable versus the fixed. It's just that there's bumps in between that could affect cash flow, and people need to be wary of that.
Okay, thank you, Joe. And you kind of answered my next question, but maybe you can dive into the a rate review of the the fixed versus variable. What are the best rates we're seeing now?
Yeah, so this is a little bit of a different. Usually, when we post rates, the rates are everybody's kind of in the same zone. These are the lowest rates from a number of different lenders, and they're all over the map. And it's because the market's a little bit all over the map. We've seen bond rates go up 60 basis points from the start of the war, or so in and around that neighborhood. We saw them pull back a little bit last week. Now they're pulling forward again this week. So the bond rates drive the fixed rates. Right. So when you see there's concern in the marketplace, there's risk in the marketplace, there's fear in the marketplace, fixed rates are going to edge up a little bit, which is counterintuitive to what the variable rate does. The variable rate is based strictly on the BOC, and the BOC makes those decisions strictly on benchmarks like inflation, unemployment, and GDP. So we're seeing a nice little spread now happen between the fixed rates and the variable rates. You can see the 5-year variable is down to 3.6. We might even be able to get 3.5. And the 3-year, let's say the 5-year fixed, even at 4.24, even if we got 4.19, 350 to 419 is what, 69 basis points? That's enough of an incentive to take the variable. We're actually seeing some people take the variable to qualify for more mortgage money because they would qualify for less house if they took fixed. And then when they close, convert to the fixed, because now you don't have to qualify. It's just an automatic conversion. So there's some people are kind of dealing with the marketplace right now and adjusting. But I'd say we're seeing a much larger proportion of variable rate versus fixed rate right now. On the conventional side, we're up to 469, 459 on a conventional 5-year uninsured 30-year M. But the variable is still down to 3.7. So those spreads are even getting larger on the conventional side. The non-income qualified is down at 189. So rates across the board aren't that bad. If I had to make a guess, usually we can give you an idea what rates are going to do for the next year or year and a half. We really can't do that right now because there's just so many variables. It's such a fluid market. But I would think, once the everything kind of settles, you could see low threes potentially on the variable side and mid to high threes on the fixed, and you'll have a nice balanced market that we can do business.
Okay, thank you, Joe. And so the next question is, where's the market at? And, one of the key metrics, of course, is sales over new listing ratio, along with months of inventory. But, can you tell us about the sales over new listing ratio on a national basis? And then, of course, the markets are extremely regional. So maybe break it down by city as well.
Yeah, you know what, 100%. And I think if we look at the market as a whole, if you ask people on the street, what do they think about the housing market in Canada? A lot of them are going to say we have a housing crisis. We're in a housing crisis. We are 100% not in a housing crisis. We are 2 points off a 100% perfectly balanced market in Canada, right? But you don't sense that. You don't get that feeling when you're talking to realtors and customers that we're in a balanced market. It's because there's some anomalies in that marketplace. But as a whole, and this bodes well for Canada. I mean, it's through all the noise. You got to look back 5 years. We had the pandemic. We had affordability issues. We had interest rates go up 5%. And then, we had the issues with the U.S. coming into power and the economy. And now we have the trade war and the energy crisis. And yet Canada is still at 100% balanced market. I think that's just a good sign for the Canadian housing market. And then when you break it down by city, you get to see where the variance is. So when you look at all the cities together, these 7 main ones, you can see that everybody's in a balanced. Montreal was in a seller's last session, but it just came back down to balanced. So everybody's in a balanced market except Toronto and Vancouver. Toronto and Vancouver are fully entrenched in a buyer's market. And it's entrenched in a buyer's market, not because of anything, formulaic. It's affordability, right? And Vancouver and Toronto, because most people are, when they come to Canada, are going to go to Toronto and Vancouver. It's a melting pot. They'll get comfortable and then they'll move from there, or they'll relocate close to the area from there. But they all come to Toronto and Vancouver, and that puts affordability at a benchmark. And it's the same type of affordability they face in Manhattan, London, Tokyo, any major international city. So the way we're going to deal with affordability is in Toronto and Vancouver is by leveraging houses and leveraging that income in houses. The government's made a lot of rule changes to help the use of rental income, the ability to add rental income. But if you're going to want to buy in GTA and your income is capped to a certain number, you can do it if you have a basement apartment or if you have 2 basement apartments. So we're starting to see affordability get dealt with in the Toronto, Vancouver regions by adding revenue to real estate, which, when you look at the market as a whole, it puts a premium on those freehold homes. So if you're a first-time home buyer today, or you're in a condo or in a townhouse, if you can get into a freehold home in the next 12 months while we're in this buyer's market, it's a perfect time to do it. Prices are depressed, rates are decent. You can move into that freehold property or get a freehold property. That's going to be a premium property in a couple of years. Once we open up immigration, once we get resolved with the U.S., once we potentially stop the foreign buyers ban, there's going to be a freehold on those type of properties.
Yes, thank you, Joe. And just by way of explanation, so people can interpret the numbers. So the threshold for a balanced market, generally 40 to 60% for sales over new listing ratio. So less than 40, we're into a buyer's market, and over 60, a seller's market. And in between 40 to 60 is balance.
Yep, perfect.
Very good. And so next on the docket here, the Ontario HST rebate. So that's a big one for anyone considering buying a newly built home. Can you walk us through the Ontario HST rebate program? Who qualifies? How much can they save? What are the deadlines they need to know about?
Perfect. Thanks, Van. So yes, the HST rebate is just another tool the government is using to help first-time home buyers get into new homes. It's also helping to revitalize the new home market. I'm pretty sure that I think last session we showed a chart that kind of broke down what's being built. We had purpose-built rental, we had condo residential, we had single family, and both condo residential and single family have been going down for 4 years. We've had very limited construction in the condo market because there were so many coming to market, and we had very limited action in the single family construction. And it's just it was getting costly with bureaucracy and fees from the government. It was getting very costly. So what's going to happen is if we don't build new homes, if we don't build single family homes, the single family homes that we have are the only homes that you can add revenue to, and they're going to become a premium in the not too distant future because we're not building them. So the government introduced this program to help consumers get into the marketplace. So if you buy a place up to $1 million, you're going to get back 13% of that purchase price in HST rebate. So up to $1 million is 13%. For the same thing from $1 million to $1.5 million, it's capped at $130,000, right? And then from $1.5 million to $1.85 million, it staggers down from $130,000 to $24,000, and over $1.85 million, it's a flat $24,000, right? So the intent here, the big savings is on the $1 million or less. And that is to get younger first-time home buyers into single-family residential properties. So it's a great program. The contract date has to be done between April 2026 and March 2027. The construction has to start no later than December 2028. The completion date of a rental has to be December 2029, and the completion date of a primary residence would be December 2031. So that's pretty much the nutshell. That's what we know. There's stuff that we don't know. So we don't know how the lender is going to do this, right? Because now we have a purchase price of $1 million. well, is it really 870 because of the rebate, or is it already taken the rebate and it's really $1,130,000? So where are they going to benchmark the value for the appraisal for the mortgage? Right. So there's still some data we need to learn, and we're following up and we're keeping an eye on this. But right now, it seems to be a very effective program. I don't know if it's moved the needle yet, but I can tell you just from in the last 2 weeks, we're busier than we've been in the first quarter. So our second quarter of 2026 is much more active than our first quarter was. So I'm hoping that maybe this is trend and not blip. We have a lot of slides that we weren't able to put in today because we're time bounded. But when you look at the market in resale activity in Toronto, it was the first. March was the first month bumped up in the last 6 months. We haven't seen any growth above zero. March was the first one. So we're hoping to see that we're hoping that becomes more trend than blip, and we roll into a decent summer in terms of activity.
Yeah, that sounds good, and that's great information as always, Joe, and it's great to see you. Thank you.
Thank you, Van, and I look forward to doing this again, and we'll do another update for you in June.